Hi, everyone. I'm Scarlet with Bloomberg Television. This is the Cornell Tech at Bloomberg Speaker Series, where we sit down with leading figures in global technology, thought leaders, entrepreneurs, investors, and we bring you conversations to produce new insights and raise compelling questions. You want to catch our prior episodes, you can do that on the Inside Bloomberg page on YouTube. You can also follow our podcast, Cornell Tech at Bloomberg, on all major platforms. In this month's edition, I'm pleased to welcome Jarrid Tingle. He is co-managing partner at Harlem Capital Partners here in New York City. And the firm has a mission. It is to change the face of entrepreneurship. How? By investing in 1,000 diverse-led businesses in 20 years. Jarrid got his MBA at Harvard Business School in 2019. Prior to that, he worked at ICV Partners, a minority-owned private equity firm. Jarrid, thank you so much for joining us for this month's edition of Cornell Tech. Looking at your bio, which I gave a brief synopsis of, you've been in finance for your entire professional life. You studied economics and finance at Wharton at Penn. You were in investment banking at Barclays for 2 years. You moved to PE for 2 years before you co-founded Harlem Capital. But your original plan in life was to be an engineer. So what changed your mind?
So I actually did a program at MIT the summer between my junior and senior year of high school. So I learned a lot there, 6-week, pretty intensive program. But I was pulling all-nighters. And as a high school student, I wasn't that happy about it. And I realized that even though I liked the curriculum, I didn't like the process around trying to get to an answer. And you can get 95% there, but if you weren't 100% there, it wasn't good enough. I realized I wanted to use my people skills, wanted a little bit more balance and experience. And so after that summer, I realized that business would be the definite career for me. And so instead of applying to MIT, I decided to try to apply to Wharton for early decision. And fortunately, I got in.
Okay, and from there on, you made history. Let's talk about how your interest in finance took shape. What did you envision you're going to be doing in finance? And are you surprised with where you ended up?
I like to take things one step at a time. And so I come from a low-income background. None of my family worked in finance, so I've always been trying to figure out along the way. I was fortunate that at Penn, there was a lot of people that went into finance or consulting, and so I had a ton of mentorship. So my first step was, let me get in the door at an investment bank. I'll learn skills. I'll learn how to model. I'll learn how to do memos. I'll learn how to do research, and I'll learn how to just be analytical and also just work in a corporate setting. And if that works out, then I'll be just fine. And if it worked out well, I would like it and I would stay. If not, I would have transferable skills that I could use for something else. But actually, my first week on the job, the class above me, the analyst class above me, sat me down and said, "Hey, you got to go to private equity." And so within a week on the job, I was already angling for a private equity career. So that was my first foray into investing, and I was happy with that decision.
Why private equity? I mean, it's very niche compared to, say, the stock market or the bond market or investment banking.
Sure. So, I mean, a lot of junior talent in investment banking doesn't necessarily intend to stay in investment banking. I mean, we all know about the long hours and the work style, and ultimately it's a client-driven business. So even though there's a lot of great aspects of the job and you have a lot of chance to work on large transactions, in terms of your controlling your own fate, being a true principal rather than an agent, right? It is good to have some agency. So I do think that's an aspiration that many folks have coming into investment banking. But for me, I felt like if I was able to get in, it would just be a more stimulating job that I would find more interesting, actually investing in companies, helping them grow. There is a chance to have ownership and equity in these companies rather than just doing transactions. And so I did see that as being an attractive path that was supplemented by the dynamics around me.
Okay, so you worked at investment banking at Barclays for a number of years. Then you moved on to PE, and you went to ICV, this middle market private equity firm, where you met Harlem Capital's other managing partner. And I'm going to butcher this because I don't speak French, Henri Pierre-Jacques
That's right.
at the firm. Okay, what initially drew you to each other and laid the groundwork for you two going off to start your own thing?
So fortunately, we were friends beforehand. So I'd known him since 2011. We were in a program for diverse talent in college. And so even though he was at Northwestern, I was at Penn, we met before that. And we were actually roommates during during college between our junior and senior years of college. So I was working at Barclays, he was working at Bama, and we got to know each other then, stayed friends throughout the city. Did definitely get closer after we realized we both were at ICV. I actually ran into him in a final round interview, and I'm like, oh man, is there one spot? Is there two spots? Fortunately, we both got it. And from there, it was great because we had a chance to work for a Black-owned private equity firm that does middle market transactions. Great work experience, great team, but they definitely emphasize people. They definitely treated us fairly, and they were focused on developing us into being great professionals. So it was a great stomping ground to just learn the tricks of the trade. And very few people have the opportunity to work for diverse ran private equity funds. So we like to say you can't be what you don't see. And we knew we were going to do well, but having the ability to work under people that look like us encouraged us to take our own step and eventually start our own fund. Didn't know it would be, so soon, but definitely provided that opportunity set and that vision for us.
Yeah, you're lucky because you started off right where you wanted to be in a place where you were really valued from the get-go. You co-founded Harlem Capital in 2015, and originally it was meant to be an angel syndicate to make investments with some of your friends. Tell us a little bit about the first investment you made and whether you went out to go seek it or whether it kind of came to you.
Yeah, so our first startup investment was a company called CeedCX. So they're a commodity exchange that was focused on non-traditional commodities like hemp, and eventually if it became legal at the federal level, it would be cannabis. So we thought that was a good option play at the time. This was 2016 and early 2016 before the election, and things looked pretty good for the market. So we actually got in through an SPV that another VC that we know pretty well was running. And so we had a lot of good data, good memorandums and stuff like that. And we felt like the market dynamics were great. The challenge was that we didn't have a direct relationship with management. And it also, wasn't a space that we knew super well. So it was a bet, right? I think we invested $15K all together and we learned. It worked out fine. What happened is they didn't actually end up going to market. They were trying to get regulatory approval, and given the administration change in 2016, it just became a lot more dim. They actually realized the market dynamics were different than they expected. So we ended up getting our money back, and we learned a lot of good lessons. I mean, one of the things is if we're going to be VCs, we want to be active, and we have to have a direct relationship with management. But not a bad first deal to learn a little bit from others. And over time, we would define our strategy to be more focused on diverse women entrepreneurs, but also markets that we understood and didn't require a lot of regulatory approval.
So it was a valuable investment from that point of view. I want to get into the diversity a little bit later on, but 2 years into Harlem Capital, you guys pivoted from this angel syndicate to a venture fund. What does that mean in practice? Because I know that both angel funds and venture funds invest in startups, and startups are by nature high risk. How do you invest differently as an angel fund versus a venture fund?
Sure. As an angel fund, you're investing in startups, which is your own capital generally. And then with VC funds, you're managing institutional capital. So that's the biggest difference. You're still probably investing in similar companies. The transition was we invested in 6 startups over 2.5 years. So slow rolling it, learning, building out our network of other firms and other people, building out our sourcing pipeline so we could actually know that we were seeing high quality things. But the biggest change was raising capital. So Henri and I were at ICV for 2 years, running Harlem Capital along the way. We get to Harvard Business School. We're still recruiting. We don't know that this is going to be our business. But instead of going into an internship between our first and second year, we decided to try to raise a fund. It was not easy at all, but that was really the big shift. So we actually did a super small close of $2 million in November of 2018, and then we were a fund. Instead of writing 25K checks, now writing 250K checks. There's definitely more weight because you're investing other people's money and you're accountable. You have to report rather than just investing your own money. But the good news is you can get a better connection with management, the CEO, because you're giving them more money. You have more rights, like you have information rights, and you're seeing higher quality deals. What we realized was that there can be adverse selection as an angel. If you're an angel who has started a company or spun out of a big company and you're in a super robust network, you may see the next Uber. Most won't, though. If you're an average person working in finance, there's no reason for that company to take your money outside of a personal connection. So we realized that like everything was working in a better direction because we had more capital, more rights, better network, et cetera.
Got it. More capital equals just more access and a wider network overall. Going to that diversity point you were making, when did you first realize how big a gap there is between minority founders and non-minority founders when it comes to fundraising? I mean, I think we all can pretty much say that's conventional wisdom. We all suspect that, but at what point did you realize, wow, that gap is massive?
Sure, we realized it anecdotally first. When we were starting to source opportunities as an angel syndicate, we realized that we had plenty of diverse people in our networks. We went to schools, we had diverse friends. We were in, programs like MLT, SEO, Twigo that were all around diverse talent pipelines. And so we knew tons of smart cable people that we were peers with that were starting companies. The companies were having great growth usually. I had been around or past the product market fit phase, but they were having a tougher time raising money. Maybe it takes them twice as long. Maybe they get half the amount they want. And we realized that there was an issue, and we kept peeling back the onion. The other part of that was we were literally 25-year-olds writing small checks. We were getting asked to speak on panels. And so it hit us as like, wait a second, perhaps there is challenges for diverse folks raising money because there's lack of representation, which explains why they're having a tougher time, but also why people care so much that we're not doing that much, but they're elevating us because we're one of the few out there. We actually started doing our own research because what we found was that there was very little research done by race. PitchBook, Crunchbase at the time didn't track it. Crunchbase just started this last summer after George Floyd and some of those movements. And so we really had to just do our own thing and realize and do our own research. So we actually found over 200 Black and Latinx founders that raised over $1 million. So that validated that the pipeline is strong, even though we knew it. We wanted to just back it up with data. Mm-hmm. And then when we just thought about the dynamics in the industry, VC firms, they don't turn over that much. They're focused on the power law. They're focused on trying to pattern match for the next, Zuckerberg, et cetera. We just thought that it made sense to really dive deep. And the last thing was, at the early stage, there's still so much uncertainty. You're really taking a bet on people, their vision, their hunger, their analytical ability, all these things that need to be proven out over time. And if you don't have people that are in your corner that are going to listen to you in a fair way, there's no reason they're going to work with you. You can always say no to an investment. So we really think you actually do need particularly good representation on the early stages to help people get capital and get downstream to build their company.
Yeah, I can't count how many times on Cornell Tech at Bloomberg we've talked to investors who say that you're really betting on founders, you're betting on people rather than their ideas, because the ideas shift over time or they get repackaged or reformulated. In every interview you do, I've seen you quote statistics on the share of VC funding that women and minority-led businesses get and how much they raise. What did it look like when you first started the firm, and do you think the needle has moved to something different now?
So the stat we quoted was there's 3% of VC funding that all women and people of color get compared to being 70% of the population. That has ticked up to 4%. It's still not a lot. So we are seeing more deals get done. But when you think about the overall capital flows, it is weighted downstream at the later stage levels. And we're seeing tons of opportunities at the seed stage. There definitely hasn't been anywhere close to enough Series A, B, C, and beyond founders of color. We are seeing bright spots though. Compass is filing for an IPO. City Block Health is now a unicorn. We see Calendly out of Atlanta. This was just raised a $3 billion valuation. So it's coming. But the biggest challenge was that people of color and women weren't really getting VC funding until 2013. Before that, it didn't happen. And if there isn't capital at the early stages and there's not follow-on capital, it's going to take a long time. Because it does take 7-10 years to get to that unicorn or exit scenario. And so it's a really big lag, even though things have been moving in the right direction. So we're seeing better deals. We're seeing, more frequently deals. But again, the capital flows still have been, underrepresented for our demographics.
I love how you explain that. You really pull back the curtain on how long things take and how it shakes out. And it's not something that people in the industry often are that open about. You've talked about diversity as an asset class. Is this a new concept?
We think it is. So we like to compare it to impact investing. 10 years ago, folks are wondering, hey, is this a real strategy? Can you actually make money? Do you have to sacrifice returns? And the answer is, it absolutely is an asset class. And so you've seen big firms like TPG, who we're affiliated with, they have their anchor in Fund One. They have a big fund called the Rise Fund that does impact investing. And we've seen other institutional firms do it. We're saying that same thing should apply. There's no reason why 70% of the population can't have much more share of VC capital, much more than 4%. Like, it just doesn't even intuitively make sense. And a population of diverse founders is only growing. But what the challenge is that there hasn't been capital historically. And so you have tons of smart people that haven't even considered it as an option, right? They're choosing to do other things. So our strategies around, investing in diverse entrepreneurs, helping to create more diverse investors through our intern program. So not only building our own team, but helping people get into other VC firms. And the last part is being visible. So you want people to know that we exist, that there's plenty of diverse talent on the VC and the entrepreneur side. And so those people that are trying to decide, hey, do I go this route? That it's a really good opportunity, and there will be support if you decide to go that route.
You mentioned TPG. Does TPG and your other investors, do they think about diversity as an asset class as well? Or is this something that you help them realize?
Something that we help them realize. I mean, I think we tell a compelling story. We're uniquely qualified to execute on this option. But I think they believe it, but we're still early days. It's early innings, and we have to prove it out. So even though we've done everything right, we still have to get returns, and I think they're kind of waiting on us. But we have seen, institutional firms make some steps. Andreessen has a fund focused on diverse entrepreneurs. We see SoftBank has a fund. These aren't core funds, but they have signaled that there are institutional movements to realize this. I mean, I think the overall aim is that you do have more diverse GPs, period, that are focused on diverse folks. But you also just have main funds for big firms that are investing in these founders at a higher rate. Like, we need all fronts executing on this. So I still think it will take some time. TPG is a growth firm and a buyout firm. So at that stage, there's still not going to be enough opportunity. But if we're successful, there will be a lot more opportunities, and hope that more people follow us into this market.
Do you think one day it'll be something where these firms will allocate X% of their capital to diversity as an asset class on its own?
Unclear. I don't know. It's tough to say. I mean, what we want to do is allocate funding in portions of the population, and we hope that everyone does it. There are so many other factors at play for these later stage firms. I think if you've been around 20, 30, 40 years, it's tougher to move the ship. If you're a new firm, you can do everything right from day one. And we respect everyone and how they make money, but if anything, it gives us more opportunity set, because if folks aren't focused on it yet, it means there's more opportunities for us to really own this market.
Okay, got it. Now, I mentioned TPG. Also, Apple has invested in you guys as well, announcing a $10 million commitment to Harlem Capital. How did that come about? Were you surprised by it, or was this something that you were working towards already?
We got introduced by one of our HBS classmates. He introduced us to the head of his firm. It's a top Silicon Valley VC firm. And we met this founder of this firm. And at one point, he just emailed us and said, hey, like, I heard Apple is trying to allocate diverse managers. Do you guys want to intro? We're like, yes. So we met them, I think, in October, and it happened pretty quickly. So they announced this initiative, their Reggie initiative, racial equity and justice initiative, over the summer. We actually didn't hear about it somehow. But because we got connected with this founder of this VC firm, he thought of us. We talked. We were able to get through the process, and they committed to invest with us.
Wow, there's that HBS networking paying off in every way. You mentioned how you didn't come from a wealthy family and you didn't necessarily have a safety net growing up. On paper, to you, the economics of starting up Harlem Capital didn't make any sense because of that background you had. How did you make peace with that?
It was a very tough decision. I came out of college. Fortunately, I was receiving full financial aid for high school and college. So was starting at a decent place after that. Worked in investment banking and private equity. So was getting paid, well out of school. But then I go to business school where I have $200K plus of debt. And so that basically wiped my net worth out completely. And we did a lot of angel investing as well. So I just wasn't liquid. So, on paper, the highest expected value would be to go back into private equity where I could literally know my earnings. I would be doing well if I stayed there for a few years. And then eventually I'll work my way up and do just fine. So that was, what made sense from a math basis. Venture capital it's a tough business where, you try to raise a fund, but usually first time funds are small. When we were starting out, we saw people that we knew that were 40 years old raising $40 or $30 million funds. Like, if you think about that and what the management fee is, you can only support like max 2 people with a comfortable salary in New York City. And so the economics weren't attractive. It really does take a long period of time, and it takes performance and carried interest to really make it a lucrative path. And there was uncertainty around that. And so what I did was I just tried to dig deep, and actually I did apply to big firms. There was one firm I wanted to work at in particular, but I didn't get to the final round. I could have worked somewhere, but I figured if I did all this and I was betting on myself, there's no reason for me to, settle. At the same time, we were getting good traction with Harlem Capital, and he's like, I don't know how this math is going to work, but I see an opportunity. And I think the fact we were able to build it out while we were in private equity and while we're in business school helped, because it's not like I was out having to pay bills when we were raising money. It was like we could do it. I still had a living accommodations. I still had, the safety net of HBS. And the worst thing that could happen was it doesn't work out and I go recruit again. So that's really how I thought about it. I was still scared. We still have to put up money and invest in the fund. It's not something to take lightly at all. I mean, we got lucky. It worked out. There's tons of people that it doesn't work out for. But fortunately, we got enough support early enough that it laid at this stage. But I don't take it lightly. We got lucky, and it doesn't always work out that way for folks.
And sometimes timing plays into it as well, because you're already building on this firm, and you were doing, you've identified your mission in terms of investing in diverse founders. And then the summer of 2020 came along, Black Lives Matter, that kind of changed the landscape. The level of corporate awareness just shot up, and there was this urgency around your mission. How did that change the trajectory of your company?
So we actually things didn't change that much after the summer for us personally. We have been focused on this since late 2015. We have built up our platform. Our core has been investing in women and people of color. So that hasn't changed. I think the biggest change this summer was that, more mainstream, more established funds have been focused on it. So you see the funds I mentioned earlier that are trying to invest in more diverse founders. You are seeing, higher frequency of founders getting rounds done faster at better valuation. So terms are increasing. We think a rising tide lifts all boats. Even if we're not investing in a deal, it is helpful for us to have more founders that are being successful because they will encourage others. They'll refer us deals, et cetera. I think the biggest change is that, for downstream capital, I think we have a better positioning where firms will take a real look at our founders because they'll be, hopefully conscious that they should invest in more diverse teams. The corporate support has been great. I hope it's long term. Sometimes things happen in waves, and like you may be, the topic of the year, and then there's less support. So we have been pushing everyone we've been talking to continue to back funds over time. But yeah, if anything, it's just elevated our profile. We saw a huge increase in our feeds and likes and views and stuff in June. But in general, it's hard to separate that from just our growing success now that we're more established of a firm.
Right. This might be something that takes a couple of years to bear out as well, to see a material change. I want to get to diversity within your company and in the companies that you invest in. There's obviously a lot of research out there that shows diverse organizations do better over time, better returns, long-term returns. You're investing in companies, though, at a very early stage when they're startups. When do you think we'll likely see a difference in performance in a company's life cycle? At what point does that outperformance start to show up?
You mean diverse-led firms versus non-diverse-led firms?
Yeah, the fact that a company is diverse and it's got diverse leadership, when does that start to play out?
Yeah, so we never made the case that diverse-led companies will outperform. We hope that they do. We're not making that case. We've always made the case that these founders are underfunded. They don't even have the opportunity to create companies usually. And we thought that because they're underrepresented, there's so many ideas and markets that aren't being tapped into. If you think about it, people have different life experiences, different needs, different points of view. And if they're given capital, the best and brightest, they will be able to start and just change things. And we talked about how, AI and different things weren't adequately working for people of color and things like that. So that's the case we made because we don't have enough data to say otherwise. I have seen some stats that, public companies and diverse boards outperform, but like we're talking about early stage companies.
Yeah.
As we went through time, we did see some good insight. I mean, MassGen, there's a MassGen challenge that in a report that BCG wrote. I think they looked at over 400 companies, and they found that the women-led companies, at least, had higher revenue after only raising half the funding. So that was a positive thing. We're definitely capital efficient because we have to be. First Round Capital did a 10-year study, and they found that the women-led companies outperformed. The challenge when you think about this from a racial lens is the data set and the sample size is so small, you can't even begin to to really compare. But Kaufman Fellows, they did do a great report with Marlon Nichols at Mac VC, and he found that diverse teams, and again, it's bucketed women and people of color, that at least, if one of the co-founders is diverse, they did generate higher returns. But again, that's not the case we're making. We hope it's true. The case we were making, though, is they're underfunded. The valuations usually aren't as high. They're not getting money just to start ideas. They actually have to prove real traction. So we definitely saw inefficiencies in the market, and we saw alpha opportunities, mainly because the market wasn't pricing them appropriately at the beginning. Hopefully the outcomes outperform, but even if they don't, we'll be very successful because we are seeing the best founders of these groups.
Yeah, no, I guess I was thinking of the research on the publicly traded companies on diverse leadership. But you do bring up an interesting point, which is this idea that most funds that are focused on diversity are looking at gender diverse companies as opposed to racial diverse companies. Talk a little bit about that, because that's a distinction you make, and not enough people think of it in that way.
Yeah. So let's see. On the gender side, I mean, it's just easier. I mean, because you can, I guess, more easily put people in an algorithm. You can make inferences about their name and obviously how they present socially and decide if they're a man or woman. People have been less inclined to code by race. I mean, you're not going to ask somebody, in a survey or anything. And then some people were afraid to guess. I mean, we think you can't measure what you don't manage. It's not perfect when we do our own analysis, but usually what matters less is, how you identify, and more what matters is how the world sees you, because that's going to influence how people treat you and how much you raise capital. So that's really the distinction we've been trying to make. We want, data sources to code by it. Fortunately, Crunchbase now codes by race, which adds some data behind it. But I think people have shied away from it. So if you're worried about lawsuits, if you're worried about, getting it wrong, people say, okay, well, I don't want to do anything. We're going to be colorblind here. But then you see the same patterns persist where people of color are locked out. So we do think there needs to be more thoughtful analysis. We've seen some studies where people, run names, they run searches on images, they look at zip codes, and you basically can have, 85, 90% confidence interval that someone is a certain background. But we think that's enough because, again, even if people don't say it, they're definitely making analysis on, what race you are. So we think that, more thoughtful analysis needs to be done, even if it's, people self-identifying, and you will see more trends that matter. But I think hopefully, given this what's happening in the last year, people are leaning in more and are being very explicit. Like before, June, you weren't hearing people say, hey, we want to back black funds and black startups. You just weren't hearing that at all. So we do think it's a move in the right direction.
Okay, got it. I also want to touch on this idea about how you've talked about how a fund's approach to diversity should really track every step of the process, from sourcing investments and founders to the ultimate investment decisions overall. That's a lot of steps along the way. At what step do you think it's hardest to maintain diversity or to focus on diversity? Is there a step at which it's an extra obstacle or it's particularly challenging?
Mm-hmm. I don't think it's that hard. It's not hard for us. I mean, you, as a fund, you already have to track all the deals you see because you have to report out to your investors. And so you're tracking the company name, you're tracking the founder name, the industry, probably the stage, the revenue, what geography it's in. how hard is it to add another column for race and gender? Like, it's not that hard. Maybe you don't want to do it, maybe because you're afraid if you record it, your stats are going to be awful. But we do think you have to measure it or it's never going to change. So I don't think the data collection part is that difficult. The challenge is that, a lot of firms are referral only in practice. So, a lot of firms don't have their website, their emails on their website. They're only getting warm introductions from their network. And if you're only investing in Silicon Valley firms, folks that graduated from Harvard or Stanford or spun out of big tech companies, yes, your network's not going to be diverse. So people have said there's a pipeline problem. There is none. But if you are fishing in the same pond, then you may think so. After that, though, you have to see, how people convert into your funnel. And some firms don't pay attention to it at all. They're just saying, hey, like, here's a company we like. Here's a company we invest in. But we look at different segments. We look at, okay, who do we take a first call with? Who do we do further due diligence with? Who do we actually do an investment memo with and take to our partner meeting? And, not all firms collect that data, but we do think it's essential because if you don't track that, you don't know where your biases are. We found early on our own that we were passing on women at a higher rate for being too early. And once we identified that, we changed it, and now it wasn't an issue. But if we never looked at the data, we would never know. No one could ever hold us accountable, but that's a bias we would have had. So until you actually look at the data and see, you don't even know what you're doing because a lot of decisions you're making quickly and a lot of decisions you're making unconsciously.
Really interesting way of putting it. You mentioned a lot of firms don't have websites where they put their email address on there. So a website might exist just to say what it is, but no one has any way of getting in touch with any of the principals there. You guys are different. I looked at your website, Harlem Capital. Your email addresses are on there. You welcome pitches from founders. What kind of pitches do you get from these founders? Do you get a lot of different types of pitches, or are they along the lines of what you've already invested in based on people looking at your prior history?
It's a mix. I mean, I think the more time you invest, the better off you'll be. We're very clear about what we do. So we invest, between $500K and $1 million in seed rounds of $1 to $3 million. And we have our valuation target. We target 7 to 10% ownership. We invest all across the US. We have these industries that we like, but we're generalist. A lot of firms don't have that level of detail. They may just have their team and they have their portfolio companies. And so the market doesn't really know what you invest in. They have to make inferences. And if you don't have that data, you're not transparent, then how will people know? So we are very clear about what we look for. And we know, again, it's always going to be up to our judgment. But in terms of what we've seen, I think we've done 2 deals that we've gotten inbound from management. There's definitely lower conversion. You're more likely to do a deal that comes from somebody that you know and trust. But we still think it's very important to be accessible because historically, if you're a great founder, but you don't have the network, or you're not in Y Combinator, or you're not in Silicon Valley, you've been effectively locked out. And we think it's very important to open that door. We definitely have a higher conversion on our, VC referral companies. But every now and then we find a diamond in the rough, and we're very happy that we have it. It does take, effort to manage that flow. But we think it's a very important part of our strategy, and one that's worthwhile.
And one that distinguishes you from others in the industry as well. Your team has posted videos explaining different parts of the business as well. One of your co-founders, for instance, documented a pitch that you made to LPs for his show, Hustle on Vice. So the level of transparency kind of goes across the board. Are there any drawbacks to this kind of transparency?
I mean, it's a lot of work for sure. So, I mean, it just takes time to put out content, but we definitely have received, a great return on our time. Where it comes to play is people just know of us. They're top of mind. I mean, most firms, they do networking calls, on a regular basis, maybe every month, every quarter with firms, but you don't get a lot of leverage. You talk to one person at a time. When we put out content on social or get press, thousands of people see it every time. And so it's a much more efficient way to stay top of mind and really solidify our place as a diverse lens leader. It can be nerve-wracking every now and then. You get, a bad quote or, a publication piece that you're not super excited about. But the nice thing is we have so much volume now that we're not too worried about any one particular piece, and just takes the pressure off. It definitely is high risk. We've seen peers have bad coverage, but if you're doing the right thing, you're doing what you say you're going to do, you treat people well, then, we're going to have a lot more positive negatives. we're having a lot of positive feedback. We do every now and then have a comment that is bad or whatever, but you delete it, you block it, you keep moving, you don't let it affect you, and you just get used to it. And it's not like we're super well known. We're well known in the VC community, so we can still live our lives pretty normally otherwise.
Right. And part of building your profile, of course, is getting new talent in as well. I've read that you've had over 50 interns, which is a pretty large number given that your full-time team currently is, I believe, 5 people. What do the interns do? How do you manage all these interns when you don't have a lot of people in the firm?
Mm-hmm. So we had 58 interns over 10 classes. So we do it 3 times a year. We had 5,000 applicants, so it's about a 1% admission rate. It is very competitive to get in. So it's a good process, though. And I mean, now it's streamlined. We have a pretty set way of getting through it. Like we have rubrics, et cetera. But it works out pretty well. The internship is part-time and it's remote. So it doesn't actually take that much bandwidth once they're in. They're basically working on projects the whole time. They spend a lot of their time helping us with diligence. So they help put us together investment memos. They do research reports for us. They do content. So we have them draft our newsletter. We have them interview people for our podcast. And the good news is these people are great. So in large part, it's experienced hires. We'll take 1 or 2 undergrads, but usually it's people that are working for a few years or in business school and can hit the ground running. They've already worked. And so they come and they're just sponges and they're overqualified, but they want an opportunity because there hasn't been many opportunities in VC. So we've had pretty good success. We've actually hired 3 people out of our intern program to join us. 2 are already on our team. 1's going to join next month. And then 14, including those 3, have went into either VC or private equity roles. So we're literally executing on our mission of helping people get into the door. And then a bunch of others are working at tech companies, working at financial firms. So everybody's doing well. And it helps us, right? If we help more diverse people get an ecosystem, our profile increases, they send us deals, they have success, and it creates a nice network and a nice feedback loop.
Yeah, it's a virtuous circle. So the theme that emerges really is democratizing access to funding, to the industry, to markets. Given all of that, and we're in this weird moment in time right now where you've got retail investors driving up shares of GameStop, AMC, American Airlines, Silver. I just wonder what you think about what we're seeing in the markets from the lens of democratizing access to markets overall.
There's a lot of changes going on right now. I mean, looks like GameStop and AMC have came back down. So, I'm sure people made and lost a lot of money there. But I think people are just demanding to get into the capital markets. Areas where people haven't historically had wide access, people want it. So you're seeing crowdfunding taking off for startups. People that haven't been able to raise VC or want to raise in a more democratic fashion or raise in that way. You're seeing VC funds raised through crowdfunding. You're seeing rolling funds. You're seeing a lot of innovation. I think ultimately more capital is great. It helps more people with ideas get off the ground, and it's definitely high risk, high reward. 90% of startups fail or don't return capital, so it is very tough. But if you can gamble, you can do all these other things, and you should be able to participate. I do think I want to see transparency around information and want people to know what they're getting into, but I think it's a positive thing. People will get hurt in the meantime, but eventually I think equilibrium will be a point where people can make informed bets and participate. Because what you're seeing is that, over the last 40 years, been tremendous wealth inequality. Wages are flat. Interest rates are low, so you can't really earn in the bond market or the loan market. So what can you do? You can invest in stocks. You can invest in private companies, and you see, all these gains that the rich are getting, but the average person isn't getting. And so I understand that there's a desire to get involved, and I think people should be able to get involved.
Okay, I guess we're in the stage right now where there's going to be some pain inflicted on those who aren't as prepared for the risks that they're taking. We haven't gotten to your companies yet in your portfolio. You've said that you got about 1,000 pitches in 2019, 2,000 in 2020. What was the most unique pitch that you saw during that time?
That's a good question. I mean, definitely Castrop. So it's ran by a founder named Ruben Flores. The company is a mobile e-commerce storefront. It enables small, medium-sized businesses to sell online within 15 minutes. So it's mobile native. You don't need hardware. You don't need a laptop. You literally just need your phone, and you can start an online business, completely variable pricing. So we got introduced to this founder through an MD in the TechStars program. We ultimately met with him, and his vision is so big. He wants to literally buy Sears Tower and name it Immigrant Tower. He was undocumented, came over when he was 13, eventually got his citizenship, taught himself how to code via YouTube, and just like had all these like lofty goals that could back it up. Like he can code himself. He's a great storyteller, and he's done all these things that are very strong. So he definitely is one that stuck out the most. I mean, everyone who pitches him loves him. He has an HBS case coming out. Our professor, who's talked to thousands of founders, said, hey, like he's one of the strongest I've ever seen. So he was definitely the most unique. We moved the fastest we ever did. We got from first call to decision in like 8 days, which is really quick for us. So yeah, he's definitely the one that stood out the most.
Sounds like he was also the most ambitious as well. Is there an investment that you regret passing on?
Yeah, so there's a company, I won't name it, but they're an alternative asset management platform. They allow you to invest in basically collectibles. And the founder's great, super strong, super data-driven, market leader. And, it was tough. I mean, I found out his story is really compelling. He actually, got hurt in an accident a while back, and so he's in a wheelchair. But, great, super smart guy who's really overcame so much adversity and, is going to run through walls, has had a tremendous amount of success. So, we got pretty far along with this one. I was upset that it didn't go through. Ultimately, the challenge was that our investor network, they weren't comfortable with the platform, and then my team didn't get comfortable with the platform. What we did was we adjusted our process. So now we do investor feedback and deal returns early. And so if there's things like deal returns or the market doesn't like the business as much, we know that early rather than wasting management's time. So I was really upset with it. I think they were too, but his business has grown. Well, he's going to be just fine. I just wish we were able to do it together.
All right. And I wonder, with COVID-19, we're now a year into the pandemic. Are you getting different pitches as a result of the environment that we're in and different kinds of founders because of the pandemic?
Good question. We see tons of e-commerce and software. I mean, you see the adoption of e-commerce, spiking. Things that would take 5 years are now taking months. I think because people want to shop at home conveniently, and that's going to continue even after COVID. Who knows how long it'll be, but even afterwards, people are going to see and demand convenience. And software is still pervasive. I think you're seeing more companies try to drive towards efficiency, trying to increase margins, trying to be more efficient, et cetera. So those two markets have been really good in terms of like those companies later stage have been doing well in the stock market. From an early stage, they've been getting tons of financing from VCs. You're seeing rounds get preempted, et cetera. So those are exciting spaces. In general, though, we are seeing, people of color come to market and have a lot of success. These rounds are moving quicker, so we're excited about that. Fundamentally, though, I mean, we're getting more warm intros. I think in this market, it is tougher to meet somebody from square one and get to conviction in a short period of time. But in general, we're seeing just a lot of tech-heavy startups, which we're pretty excited about.
What's one question that you ask of every founder that you weren't asking 2 years ago?
That's a good question. We definitely focus more on unit economics now than we did before. So we'll pressure test their assumptions. So if they say, hey, we're going to raise $1.5 million or $2 million, it's like, okay, how much runway does that give you? Before, you would let a founder get away with saying, 12 to 18 months. Now you really want 18 to 24 months because you don't know what the environment's going to be like. We don't know if another recession's coming. Really, a lot of uncertainty, even though, the stock market and everything is going well and there's tons of capital out there. You just don't know. And what we're also seeing is that the Series A bar is increasing. So it's harder to get from seed to Series A. A lot of founders are having to do bridge rounds or seed plus rounds. So we think it's very important to have more runway. So it allows you just to have more control of your fate. You don't have to take bad terms. You can grow and get the best terms and positioning possible. So that's what we're focused on now. There's other things, but that's been the biggest change because there's just different dynamics at play in the capital markets at the early stage.
Jarrid, really appreciate your sharing with us all these different thought processes that you have at Harlem Capital Partners. Jarrid Tingle is managing partner at the firm, and I want to bring in two Cornell Tech students who have questions for Jarrid. Let's go to Daswell Davis for our first question. Daswell?
Hi, Jarrid. Just want to say thank you for the tremendous work that Harlem Capital is doing to remove barriers to entrepreneurship for diverse founders. The question I have for you is, raising capital for a fund is very challenging, especially as a minority yourself. Early on, can you tell me about a moment or a meeting that was so demoralizing that you thought to yourself, hey, maybe this isn't it, and I should do something different?
Yeah, it's really hard, particularly at the beginning before you have capital. So I'll frame it this way. Once we got in front of like one of the founders of private equity at a huge firm, and he at the end of the meeting said, if I should get the money, that gave us confidence. This world-class investor now believes in us, we'll be fine. Before that, though, we got beat up a lot. I mean, we had a fund of funds we talked to. We actually went up to a different state. We took the train, and they were like, hey, I don't get it. Diversity is not a strategy. Like, what industries are you focused on? And this firm is focused on investing in diverse GPs. But when it came to actually investing in diverse GPs that are investing in diverse entrepreneurs, they had a barrier. And so like the meeting didn't go well. We traveled, we spent the whole day going up there, and that was demoralizing because this is someone that should be inclined to do it and probably went through the same things that we went through when they were getting started. So that was demoralizing. We had another meeting at the Harvard Club through a connection, and this person is literally yelling at us at the Harvard Club. Like in the library of the Harvard Club. We're like, man, I literally just want to like crawl under the table and get out of here. But you can't do that. You have to finish the meeting because it's a small world. You never know. But we had some horror stories. I mean, we try to like block them out, but those are two of the worst things that made us really reevaluate. But fortunately, again, we got the good confidence boost from enough people and figured out how to structure our process, our introductions to really decrease that frequency of those kind of bad meetings happening.
And the fact that you're laughing about it now as you're recounting shows that in the end, you learned something from it, you moved on, and it all worked out. I want to bring in another Cornell Tech student, Tole Mwawuganga, for our next question. Tole?
Yep. Thanks, Jarrid, for the time as well. My question is basically on, there's research that shows that, still 80% of venture funding still goes to kind of like 3 states in the US. And, minority funding is still about 3% right now. So I'm just wondering, what are some of the ways Harlem Capital is involved in, especially getting early stage, minority-owned ventures, at the very early stages, in getting into venture funding at later on? Like, are there ways you guys are involved in kind of just supporting that ecosystem and building up the startups to come up into the venture?
Sure. I mean, we're definitely better at helping companies grow than get off the ground. So we are investing at the seed stage. Usually the company has raised angel funding, has been around a few years. There still is a gap earlier, like when people were doing friends and family and angels, like we can't take that risk. I don't believe you get compensated for that risk at all, but I do think it's a void that needs to be filled. And so we are happy that accelerators are moving in that direction. In terms of our lens, though, we try to stay as broad as possible. We don't want to have any constraints that make it tough for us to back founders. So we don't have an industry focus because we want to make sure we can meet the best founders wherever they are. We invest all across the US. So out of our 21 investments, 5 have been in New York State, 5 have been in California. The rest are all across the country, invested in Indiana, Chicago, Atlanta, all over the place. So we keep a broad lens. I do think we partner with people that are focused on this earlier stage. Techstars is great. They have dozens of cohorts throughout the US, take about 10 startups per class. And actually 5 out of our 21 companies are Techstars alums. They're great. Their classes are very diverse. I think over 50, sometimes 70% are ethnically diverse. So they've been doing the good work. But we like to say our brand, our social media strategy helps. So what we do is we provide information. We tell people how we invest. We tell people about venture capital, how we make money, why people love SaaS startups, why VCs are focused on one thing versus another. So we're trying to at least democratize information and let people know what we're up to. So, we can't do it all at once. I think as we go through time, we may consider other initiatives, but the best thing we can do is make great investments and build in public and try to provide as much information to the ecosystem as we possibly can.
All right. Jarrid Tingle of Harlem Capital Partners, thank you so much for sharing some of your time with us and telling us about your story of how you got to where you are. I want to now bring in Cornell Tech's Director of Runway and Spinouts, Fernando Gomez Baquero, to give us our closing remarks. Fernando?
Thank you very much. Thanks to Jarrid Tingle. What a great story from Harlem Capital. Our moderators, Scarlet from Bloomberg, and our host, Bloomberg, Cornell Tech, and Tech NYC. Cornell Tech is the commitment by Cornell University to become that epicenter of research, education, and innovation and entrepreneurship in digital technologies. We're located in Roosevelt Island in beautiful New York City. We house here also the Jacobs Technion Cornell Institute, which is our formal collaboration with the Technion Israel Institute of Technology. This collaboration is central to the role and the mission of Cornell Tech of bringing the best of academia and entrepreneurship here in New York City. Cornell Tech is a place of experimentation, of excellence, where a diverse environment of people, of academics, of practitioners, of startups, large companies are all here building those digital products that will solve our most pressing problems. An event like this one, Cornell Tech at Bloomberg, is core to that academic experience that we bring at Cornell Tech. It's that opportunity for our community to connect, to explore the latest topics, to get to know visionaries like Jarrid, and build our community of entrepreneurship and investors. And what an amazing story. I mean, Jarrid spoke about so many interesting things, about democratizing access to markets, about having diversity as an asset class. But one of the things that really resonated with me is that this all started because Jarrid and his team found an opportunity, found something where there was little research being done. There was an opportunity. They did the research, they took the time, they found the value, they did the work, and they backed it up with data. That is an amazing, amazing learning experience. That's a great message to our audience and core to what we want to build and what we want to teach at Cornell Tech. To learn more about Cornell Tech, please visit us at tech.cornell.edu. Thank you.